Now it's time for Smart Charts with Abigail Doolittle, where we look at the timely topics through the charts with the street's top technicians. And given today's FOMC decision, you've got to be looking at that, right?
You are absolutely right about that, Caroline. Not just because of the FOMC, but we do have Paul Ciana here, the head of FIC technical analyst, technical strategist at Bank of America Merrill Lynch. And before we look at your charts, I have to give you kudos because you just told me that you are the top II technical FIC analyst in both Europe and Asia. So congratulations.
Yes,
That's
thank you very much. I appreciate that.
Amazing. So we're very happy to have you here.
Thank you.
So now, without further ado, let's take a look at your 10-year yield chart. The whole FOMC day turned out to be a little bit of a snooze, at least for stocks. What are you seeing for yields?
It did. It was a bit quiet of a day, but you know, the reality is we're bullish bonds. We still are. We've been on the show talking about that. And the move here in Treasury yields off sort of peak pessimism this summer has brought 10-year yields up to about 1.9%. The last 3 days, 10-year Treasury yields have come down a little bit, correcting a little bit of that. And I think it's fair to just stay bullish, sort of buy the dip in the bond market while we're below this technical resistance. You can see the trend line connecting prior yield peaks coming right down here into the 2.208% area. And there's 2% line kind of coming back through some of those prior pivots. So as long as yields are down here below 2%, I think it's fair to say there's still a real risk of 10-year Treasury seeing a new all-time low.
Okay, so you don't think we're just going to whipsaw between, say, the last low around 1.5% and 2%? You think we could actually even go significantly lower? And I think the all-time low is what, 1.38%, somewhere down there? 1.37?
Yeah, all-time closing low is about 1.38. I think intraday we got down to 1.31.
So you are a buyer of bonds. Let's now put this together with the yield curve.
Sure.
You have an interesting long-term chart here.
Peak optimism, peak pessimism. August was a bad time, a bad month. We saw 2s, 10s invert. The end of August, the spread between 2 and 10-year Treasury yields closed below zero. The last time that happened, and then the following month it uninverted, was back here in 1998. So, Abigail, what we're looking for to kind of see some sort of optimism come out of this month, and frankly what I hope might come from the Fed today, is for some steepening. We haven't really seen that yet. The month's not over yet. But if 2s, 10s end September uninverted or positive, it could be a reason for some of this last gasp risk-on sentiment to persist longer than expected.
And how long would you expect that to persist? Maybe we were just talking about this, maybe the fourth quarter, a little bit of a continued risk-on sentiment?
Yeah, so there's a lot of technical cycles at play here. The presidential cycle has been well featured. The holiday cycle, the potential for a Santa Claus rally. There are reasons cycle-wise to see some risk on. The next event, the Fed's over, October trade talks. If they happen, how good they go, we have to get through that.
Well, 210 spread, as always, a must-watch, especially on the end of September to see if that holds. Now, finally, this chart I absolutely love. This is a powerful message, even though timing might be a little bit difficult.
Yes, it is. So bigger picture, stepping back to a long-term ratio of bond prices versus the Russell 2000. What you can see going all the way back to 1994 is a great trend line in this ratio connecting economic cycle peaks. So this ratio troughs when sort of the cycle and risk is peaking twice, 3 times. This was the global financial crisis, and then over here, the start of trade wars. So now this ratio is breaking up through declining trendline resistance. It's now made yet another new trailing high. The threat here in the bigger picture is that bond prices outperform the Russell 2000, which would be bullish bonds, lower Treasury yields, and certainly a risk to equity markets.
Well, you know, it's certainly a risk, but take a look at how quickly it's happened. They always say that you take the stairs up and the escalator or the elevator down in stocks. This chart would certainly support that.